Welcome, everybody, to this edition of the Atlanta Startup Podcast. I'm Lisa Calhoun, your co-host today, and the founder and managing partner at Valor Ventures, a seed stage venture capital firm here in Atlanta. I am really excited to introduce you to my guest today, Rob Piechota. Rob, thank you for joining me.
Thank you for having me. Absolutely glad to be here.
So Rob is a leading expert in transaction tax. I didn't even know that was a thing until we met a few weeks ago at a middle market private equity conference. And I learned of all the things that can happen after a founder already has a signed acquisition opportunity. And Rob's kind enough to say, I can help you work through some of those details and talk through some of those pitfalls. And so that's what we're here to discuss today. He's with the firm Alvarez and Marsal. And let's start there a little bit. Alvarez and Marsal, how many offices, how many practicing attorneys?
Alvarez and Marsal is a global professional services firm that focuses on management consulting. Well known in the spaces of corporate tax restructuring, overall corporate restructuring, as well as tax transaction services. And that's where I come in. Like I said, global. So while we have offices in Atlanta, we have them on practically every continent and all over the United States.
So you can help a founder wherever he or she may be.
That's correct.
So we're going to jump right into the sticky stuff. For most of the startups that Valor backs, what those founders want more than anything else is an IPO, and barring that, an incredible acquisition. And every day we talk to founders who are working towards getting that great acquisition opportunity. When they sign that deal, though, it's not over. What are some of the pitfalls that come after an LOI is already signed?
Well, then if we're talking about getting into the due diligence phase, there's going to be various types of due diligence being performed. Legal, HR, everything under the corporate umbrella, which of course includes tax. A lot of times tax is a little towards the end of the tail in terms of ordering, but that does not mean it's not important. And once we do get involved, depending upon the scope and the breadth of the company itself and the different jurisdictions that it touches, it can be everything from state and local tax, where I specialize, through federal corporate income tax, through international tax, transfer pricing, et cetera. What really kind of caught my ear when we were speaking at the conference was the fact that Valor is so heavily invested and interested in software companies, right? Because on the state and local tax side, sales and use tax is near and dear to my heart. And companies that are at one point in time or another hoping to be acquired, hoping for that IPO, really going to need to think about sales tax, or it's going to be thought about for them when due diligence occurs.
So open that up for me a little bit. What are some of the possibilities? So acquisition offer comes in and it's like, hey, we're going to give you this multiple on your revenue. We're going to have this kind of an earnout. These are the highlights of the deal. Usually one of the highlights of the deal is not tax. So what happens after these things come to light? What are some of the gotchas, one of the things to look out for?
So once some of the important tax information starts to get shared, you start to get a sense of what the overall footprint is of the company for various different tax types, right? Not only federal corporate income tax or, whether it's withholding tax, et cetera.
Most of our founders are operating, selling software, not only across the country, but usually in a few dozen countries.
Mm-hmm.
And, some of them in 200 countries, but that's a little bit on the high unusual side. So software is, it's easy to see that it's, a global industry. Mm-hmm. So does that have global tax implications at acquisition?
It absolutely can. It absolutely can. Probably the most impactful element that can happen is an impact to the purchase price, right? Everybody is going to pay attention if something is going to be an actual deduct from the purchase price because of a known and acknowledged issue that is spotted and agreed upon by both sides of the transaction. And that's where sales tax, it has become a real prevalent issue in the software space. It's really due to a couple of factors. Happy to elaborate on those now.
Please do.
Okay. So sales tax is a transactional tax, right? It's You selling something to me, I pay you something. You as the vendor have a collection responsibility. Collection responsibility, percentage of that transaction purchase amount has to be collected from me in form of sales tax, state and local levels, then remitted out to those jurisdictions. So that's kind of setting the table. But in order for you to even have a collection responsibility, you have to have something called nexus, or an actual connection with the taxing jurisdiction that obligates you to collect tax from me. And things have changed since 2018. They've evolved very, very, very quickly because of a Supreme Court case around Wayfair. You've heard of Wayfair?
Of course.
Online shopping.
Yes.
Really what happened there was the inception of what's called economic nexus for sales tax purposes, which means you as the vendor could be seated here in Georgia and selling SaaS software as a service. And it's not taxable in Georgia, which is great news. However, it's taxable in Texas. It's taxable in Louisiana, Kentucky, Tennessee, etc. And your customers are sitting there. And your argument is going to be, well, I have no registration requirement in those states. I have no requirement to actually collect because I don't have that nexus, Rob. I don't have that taxable connection. Well,
Unlike with employees where you
There
used
you
to
go.
paying payroll taxes, and it's like, okay, well, I have an employee in New Orleans, so guess what? But now that's changing a lot.
absolutely.
Wow.
Absolutely. Since that
That's
Wayfair
shame.
case, it is. It is. You only have to have a certain threshold amount of receipts coming from a given jurisdiction that taxes
How is it
the
defined?
SaaS software. Most of the time, it's a dollar figure amount, $100,000 in most instances. Texas, New York, a little higher, $500,000. And then there's a few out there around 250. The other test is on the number of transactions themselves. So you might not hit $100,000 in a 12-month period coming out of Tennessee, let's say, but they may also have an actual volume count. If there are 100 transactions, let's say, and they are smaller than $1,000 a piece, you're still going to be obligated to collect sales tax on all of those transactions.
Even though it's, let's assume, a software as a
That's right.
service.
That's right.
Okay. How does this play out with different countries?
Different countries are more or less out of the scope of anything that I touch from a state and local, right? I'm going to be just the contingent 48 plus Hawaii and Alaska.
So what are the top 5 most offending areas in terms of regression on sales tax collection and software?
Oh, let's see. So anything that has to, well, I'll start with the states, right? The
Sure.
bad boys that are out there, especially in the software space. Texas, really hard to get around. They find different ways to fit their definitions to suit the type of software.
Okay, they're
that
gonna
you
get,
offer.
Texas is gonna get paid.
They're gonna get,
Yes.
they're bound. That's it. Found
Okay.
it out. New York, highly sophisticated state. Absolutely. While it's $500,000 of sales that are going to generate a nexus with that state, New York is also a very populous state with huge industry. So it's going to draw more revenue than say in Iowa and Idaho, excuse me, or just some of the Midwest states that maybe just have smaller business ventures that are going to be interested in your software to begin with. Brings up another good point. I'll get back to that in a minute because Texas
New
and,
York.
and New York. In addition to that, California is notoriously known as just an overall bad boy state, high rates, tax everything. But you got to remember, Silicon Valley is also in California. And as a result, they've got an extremely powerful lobby, which has kept software off of the taxability side of the coin for, well, up to this point.
Great, so you can still get great customers in California.
There you go.
What other states are particularly ones that software founders should watch out for? Is, I mean, goodness, sales is sales. You're gonna sell to who needs you. But if you're looking at kind of retroactively punitive sales tax collections issues,
Yep.
it's a special world, but it sounds like it comes up at least for you and for your friends
That's
a little-
all the time.
all the time. And so I think it's a little bit worth exploring. Are there any other states that sort of rise to the level of watch out?
Not Illinois, but Chicago. And the rate
The
is,
city.
that's
Okay.
right. That's
Okay.
right. And the rate is high enough that you have to pay attention.
Wow.
It's higher than the state rate. So it's definitely important. Same types of rules for the economic nexus as well as the taxation of SaaS software.
Okay.
And in the Southeast, just to give everybody a little bit of the lay of the land there, Kentucky, South Carolina, Tennessee, Louisiana, and Alabama, not Mississippi, not Florida, but the rest, they're pretty hard and heavy on going after tax when it comes to SaaS software. And they've even expanded that a little bit further to think about digital products, things like I'm downloading a digital book, a digital movie, piece of music, etc. They're expanding and evolving their definitions of what is taxable, what is considered digital in
It's the
nature.
frontier that founders need to pay attention to.
Absolutely. Get that shop in order early when it's easier to do, so that the expansion of the function, the profile, all of that kind of expands real time with the footprint as it's moving into different areas and growing and thriving.
So let's look into the last, say, call it year or two for you. How many software transaction tax opportunities have you worked on, projects?
Interesting that you would say opportunity, right? And I like to think about it that way, because the earlier you address it, the less you're going to have a problem down the road at, say, when the deal closes, acquisition, et cetera. I work on a lot of transactional opportunities that involve software, probably 50 plus in the last 18 months,
And
somewhere around there.
at acquisition, how many of them would have seen an adjustment to the acquisition strike price because of tax implications they hadn't addressed?
20 to 25%.
That's a lot.
Yeah.
Okay, so let's move right into best practices.
Yep. And that's 20 to 25% where you see an actual adjustment to a purchase price, right? The actual amount of take-home cash is going to be decreased because of some tax issue that was unresolved. That doesn't account for escrows and holdbacks. That doesn't account for, listen, we disagree with your position, but we're going to indemnify you for it and kind of see what happens down the road. All of that is always going to be thought about as you're trying to protect your client, my client being the acquirer, right? The buyer that's coming in and thinking about making an acquisition and making sure that they're not going to be holding the bag if something goes haywire down the road.
Got it. No, it sounds like some very serious things. Are they very serious implications when it comes to costs?
The costs, I'll give you an example of the largest one that I ever dealt with. It was actually not only sales tax, but it was also income tax at the same time. The company sold peripheral items for computers, mice, desktop keyboards, things of that nature, and sold them directly to individuals all throughout the United States. In addition, they had employees all throughout the United States. We didn't even need to think about economic nexus. They're already boots on the ground and inventory at warehouses all throughout the United States. They were collecting sales tax in exactly 2 states, and they were filing income tax in 2 states. So we got into remediation mode on the back end to help them with the cleanup. That was the most severe. That was probably the largest project I've been involved with. It was about $12 million in adjusted price that we turned into a remediation effort that was voluntary disclosure oriented. I don't know if you've ever run into voluntary compliance with the states or any of the taxing authorities, but it's a real safe way to get good with the states. And they alleviate the penalties if you do it. Still pay the tax you owe and the interest, but the penalties, which are a lot of times 25, 30% of the overall taxes due, that can be swept off the table.
Okay.
So take that 12 million, right? That's actual tax due. Then you say, okay, what are the actual costs, which was your initial question. For a consultant like myself, the range to do a voluntary disclosure agreement in any one state or any one tax type can range anywhere from, say, $7,000 to $15,000. Again, a little wavering on the front and back, but per state, that's what they can look like, possibly per tax
Per
type as well.
municipality.
Those can also be implicated sometimes. That is true.
Okay, this can really add up.
That's true. Yeah.
Okay.
Our fees were approaching $1 million on that to remediate the actual problem.
Fascinating. So what are some of the things that you would advise software CEOs today to do to build in a future compatible way from the way you see the law evolving?
First is education. Education it has to be absolutely paramount in terms of understanding how you're offering, whatever it may be, whether it's SaaS, on-prem, et cetera, digital products we talked about. The definition of what it is for sales tax purposes, sales tax likes things to fall into buckets. And as a result, you need to know what your offering is and what bucket it falls into. Once you know that, you're on your way to having a good understanding of whether it's taxable or not, because you can look at the state's rules per bucket. But I'm not gonna lie to you, it's complicated. I've been doing this for 25 years. And it's a big part of my overall practice, and it is still very much a situation where you have to evaluate each state's rules on a real-time basis. You might know a little bit in the back of your mind, okay, well, I know New York taxes that, I need to go back and refresh, but there are constantly being issued all types of notices, appendices, any sort of, new information, bulletins, private letter rulings on different cases that might suit your fact pattern that could help you understand whether or not you're going to be taxable. There's a lot of gray, in other words. So it's education, maybe doing a little bit of the, how do I figure out where I align in the taxability spectrum? And the last thing is talk to a professional, understand what your actual offering looks like compared to what they've seen in the market, what they've seen real time in dealing with state taxing authorities.
So being a software investor, I always love to use software.
Mhm.
Are there any software platforms that get it mostly right, that can help software companies, when a customer comes on board, properly leverage taxes that they are incurring?
There are some very sophisticated programs out there that do get close, but it is not without typically a pretty high cost, to be honest with you, right? If you
What are
wanted
some of
to,
the ones that you think are doing a better job?
Avalara is one, Vertex is another. Those are probably the two that I run into most in the market and have most faith in. However, there's a caveat to that, right? If you take Avalara sales tax software off the shelf and you're a software company, every software company is unique. There are little nits and nuances and different contracts and different offerings, whether there's going to be anything else that's just a tiny nit that needs to be appreciated that's going to impact taxability. What I'm getting at is that effectively it's got to be hand tailored to your specific module, right? Whatever your platform is and whatever your offerings are going to be, Avalara or a consultant that does some degree of implementation has to sort of do that mapping and what they call coding to make sure it's aligned.
Coding, indeed. Several kinds of coding in the world.
Of course, of course.
So when it comes to making sure you've got the right, infrastructure at your firm, that's one thing. Are there any sectors that are particularly dangerous or particularly be careful of the tax rates in these sectors?
Sector
And
wise,
about the big ones, healthcare, fintech, transportation, and there's a lot of software in each of those buckets. Do they have any unique concerns?
that it's actually the other side of the coin. It's instead of concerns, you can have some benefits. Okay, so for instance, when we're talking about SaaS, when we're talking about sometimes on-prem software, there are business to business exemptions, depending upon who is actually going to be the user and the interface with the software that you're selling. Right? Great news. If you're selling onto a state that taxes SaaS software, you've got economic nexus. Oh no, well, be saved because there is a business to business exemption that can pull you out of trouble,
Really?
even if there are large dollars on the table.
Is that a fairly large umbrella, business to business?
There are maybe 5 or so states that I know of that have an active business to business that's widespread enough that it will capture probably the majority of the SaaS revenue that's being generated.
So let's ask about a developing model in software, AI. Delivering intelligence as a service is a huge and growing business.
Yep.
And we do a lot of investing in AI startups. Frankly, even yesterday, I was talking with a very sophisticated investment group, and they asked me if AI was a business model or a product or a service. And they really haven't fully formulated, because the world hasn't fully formulated how it thinks of delivering intelligence. I tend to think of software as a service as one of the many business models you could use with AI as the product you're delivering, kind of intelligence on demand. What does tax and sales law have to say about this?
Do you remember the buckets?
Yes.
They're figuring out which bucket, and Texas is saying, how do we move the bucket to catch the AI? Basically, that's what's going on right now. It's an extremely hot topic in state tax and sales and use tax in particular is how is the delivery model actually set up? Would it be taxable if it were something else? And is there anything unique to it being AI that takes it out of a taxable category, out of a taxable bucket? You mentioned before, when I was talking about the business to business, what sort of pitfalls, et cetera. And I said, well, there's potentially some sort of saving graces here. One being the business to business, and you had mentioned healthcare. Depending upon who, let's say, if it is some type of healthcare oriented software, even if it's for some use in back office, et cetera, depending upon who the customer is, who the actual contracting party is, there can be exemptions for, say, 501c3 tax exempt entities. That extends to colleges, universities, healthcare systems a lot of times, state and local governments. They're not 501c3, but a lot of times they are statutorily exempt. And then the big boy federal government always exempt from sales tax.
Got it. So a couple days ago, I encountered an AI from a husband and wife team actually that made all case law publicly available for free, which people charge a pretty penny for that. Are you aware of any tax law free resources or AIs that are in development or possibly just launched?
I am not. I am not at this juncture. No, that's a fascinating model too, because they're offering.
It is publicly available.
That's right.
Information.
That's right.
Right?
And I'm doing some mental gymnastics right now.
Things to do.
That's right. That's right.
Okay.
Yeah, but it's interesting that the reason I paused for a second too is for sales tax purposes, what's free is not always free. And what I mean by that is there is another side of the coin to sales tax, which is called compensating use tax, which means
I don't think I've ever heard of compensating use tax.
So
learning things every minute.
I got to know about it early on, growing up in New Jersey, southern New Jersey. I would hear radio stations that would advertise for come down to Delaware, the home of tax-free shopping. Delaware has no sales tax. 5 states in the country don't have a sales tax. Delaware's one of them. And that would mean come on down from New Jersey, you buy something here, pay no sales tax on it, take it home, right? Pair of Jordans, diamond ring, whatever you want. Here's the gotcha. Okay. You get back to New Jersey. New Jersey has what's called a compensating use tax, which means anything you purchased and you're going to make a taxable use of in that state where you're a resident, you have to self-assess tax on yourself and hand it over. So what does that mean in terms of software and what we're talking about? Even if you have instances, let's say, where if you're the software vendor and you're selling it to a state where software is taxable, whatever form, whatever platform we're talking about, whereas maybe you don't pass the critical thresholds, either the volume, right, the number count, or the actual dollars that are generated in that state to give you economic nexus. You're home free. Your buyer, your customer still may technically have a use tax requirement to charge themselves.
But that's on them.
That's exactly.
That's not going to come back to you.
That's exactly right.
Okay, so well, speaking of keeping your head on straight around tax, is there a window of validity, a look back period on tax for software? For example, you mentioned the laws evolving very rapidly. A lot of times with business laws, as they evolve, they come into play in stages over years. So a software founder who's looking for acquisition potentials, maybe considering IPOs down the road today, how far back do they need to look to be sure that they're keeping everything in the right boxes? So
if they have never filed sales tax returns in a state, the true letter of the law technical answer is there's no statute of limitation that's tolling whatsoever.
No, you did not just say that. Okay, I see why this comes up.
That's right. That's right. Now, I have to tell you that, right? Because tax professional, that is the letter of the law. And that's, if the state wanted to pursue you to the nth of its power, that's exactly what they would do. Now, knowing how the states operate, and I know this because I started my career working for New Jersey Division of Taxation. They don't want to chase businesses out of the state, right? At the same time, they recognize there's money due to them, and they want to be reasonable. Some states, again, Texas, California, are more aggressive than others.
Less reasonable.
Less it can be. But what will happen is you'll see kind of a general range of how far back we'll look. I'm going to say anywhere from 4 to 6 years is probably a good way to think about it. It's another sort of beauty of that voluntary compliance program I was talking about if you do a voluntary compliance agreement with a state, typically the look back is only 3 to 4 years. So you're getting some additional benefit. You're maybe cutting off some old years. If you find a problem, cut it off early, you get rid of penalties, move forward. And I don't recommend this, right? But companies make their own business decisions at the end of the day, right? Tax does not drive
Nope.
how a business does business. So I have seen clients where they said, what should we do? And I said, it's advisable to think about maybe cleaning this up through voluntary compliance. And the last stage of that is you start collecting on a go forward basis. And they say, nope, we're going to play the lottery. We're not going to clean it up and let it sit and take our chances. We don't think this is a big risk. And the truth is, it's a really just a hedge bet as far as what is going to generate that risk. Sometimes I can see a factor and know that that's going to put you higher in the radar screen than another company. And other times it's pure dumb luck as to whether or not an auditor comes knocking and says, I want to take a look at what your sales in my state are.
Well, it's interesting that you bring that up. Headlines do tend to generate a lot of looks back, and the more profile a company has, the more they're going to tend to come up on different radars and different screens. Is there a revenue threshold where states start to get a little bit more interested?
I mean, that's just, I think, human nature right there. The largest companies in our country, largest companies globally, are under audit constantly, not only by the federal government, by other foreign governments, but by every state and local government constantly on some cycle. And that's because they know, it's practically impossible to get it all right. And that's why those companies have not only huge tax departments, but they have huge flocks of tax consultants that are constantly advising.
Flocks. Okay. Like you said, you're a global firm.
That's it. That's it.
Okay. But effectively, a lot of the startups and a lot of the founders listening to our podcast today, they're going to tend to be at emerging firms. And they're excited about targets like their first 1 million, their first 10 million. A few will be looking for their first 100 million in software revenue. Are they flying under the radar in your experience, just as asking about you as a professional? Or do things start to get a little bit more interesting for some of the taxing authorities at a certain level?
The only one that probably falls off the table is the first one you mentioned, the 1 million. And that's just practical experience. Not saying it won't happen to the 1 million revenue companies that are out there, but in terms of an auditor's interest, in terms of just visibility, right? A lot of the ways that companies get audited is through sort of the web of connections that they have in the market, through other companies, through advertising, through having personal property on the ground, employees on the ground, and one thing leads to another. And that's sort of the algorithm that pushes an assessment towards a company.
So I'm going to give you a hypothetical. I know everyone, all professionals love hypotheticals. Pretend we have a 50 million a year run rate software business. It's just under 10 years old. All they've been focused on is growth. They have been trying to also do their part, filing the right taxes. They've got a professional on the team. They've got a whole room of 5 professionals working on tax and finance. But those people are also busy doing other things like looking for the right revenue financing. And it's really it's all they've been doing is growing. Now they're starting to think about being acquired. What's the checklist you would suggest to that founding team about, let's make sure that you've done what you need to do by software sales tax opportunities?
Yep. First piece is education. Education for that tax department, education for the CFO, all the way up to the CEO of that company. Let's all make sure that we understand that what we're selling is taxable, and that means something.
They go for that.
That you can start, Google, right? There's a lot out there.
ChatGPT.
A ChatGPT, of course. Conferences, middle market conferences, similar to the ones that, or the one where we met. Some are focused exclusively on sales tax.
Okay.
To have an even more in-depth conversation, to understand with their company's needs, where would be the pressure points. Probably the next most important thing to do would be if you meet someone at one of those conferences, great. Otherwise, get in touch with a middle market firm. If you're a smaller, company, 50 million, get in touch with a middle market firm to have a conversation, right? That's all any consultant wants, is to start the conversation, understand more about your business, understand what you can do and how they can be a part of the story, right? So have the conversation, and really the best prediction I can have is it's probably going to go one of two ways. One is the consultant's going to come in and they're going to say, listen, you lucked out. Your team here has done, baseline work as far as getting grounded on where your actual filing should be for collecting tax appropriately in those states. They are the material states. You're in decent shape. Scenario two is the not so good one, right? The consultant comes in and says, all right, just from a high level looking at just your material jurisdictions, let's take 80% of your revenue are into 4 states, looking at the rules in those states. You guys missed the ball. You missed the ball, and 3 out of the 4 states. And as a result, we're going to help you size it as to what that bogey can be, what that dollar figure can be. So you're at least, if you choose not to actually clean it up or do something about it now, you at least have in your mind a dollar figure when you're headed towards transaction. When a buy side due diligence team comes in and says, oh, everything's wrong, throw the kitchen sink at them, and it comes up with some, because a lot of times, if they don't get the information they want, a lot of times due diligence is done very, very quickly. Just the right data might not be presented to those consultants. They'll take top line times 7%. Here's the exposure. Here's as bad as it could be. Meanwhile, you've already done the work to contain it. And that's my recommendation.
And that kind of review, if I heard you correctly, it can cost about $5,000 per region, municipality, state,
As
per
far
sector.
Are we talking about the price that I was talking about with cleanup earlier?
Yeah.
That's the low end of the spectrum. If you're going to do a cleanup voluntary disclosure, low end of the spectrum, probably low dollars involved, maybe one tax type, all the way up to probably maybe 15 to 20, depending upon if it's an income tax issue. It's a separate type of analysis, and that's why it gets a little pricier. But sticking just with sales tax, probably the 5 to 15 range is where you're going to land. Now, that is for doing literally the agreement. Here, we help you fill out the facts. You give us the data. The data is in good working order. A lot of times what is found out is that it's not just a voluntary disclosure that's needed. It's some assistance, some handholding, some taxability analysis, some overall vetting of the information so that it is complete and accurate enough to present to a tax authority. And they say, you know what, this is a perfect format. Here's your clean bill of health. Thank you for the money, and keep collecting tax. Now, that means 5 to 15, let's say, on some of those small VDA opportunities, maybe another, depending upon what needs to be done, it's probably going to be bucketed as well. 10,000 to look at Nexus, right? So you don't know what you don't know as far as which states you're in, unless you have 10 bodies sitting in each state around the country. Then it's an easy question. But the taxability, especially when it can fall in digital products, in Texas doesn't actually tax SaaS as software as a service. That's data processing that they've fitted into that definition, but you don't know it until you've actually played with the contract and the statutes and regs to get yourself there. And that's some of the other maneuvering that can add some supplemental costs to those VDAs that get done. It's usually the VDAs that are probably what I'll call 75% of the costs.
And what does VDA stand for?
Voluntary disclosure agreements.
Okay.
Yep. Sorry. I should.
That's all right.
I should have stressed that. But those VDAs, the actual costs of those contracts themselves that you help with, that's going to be the lion's share. But the other piece is going to be making sure the right polish is on them and the right picture is created going forward so that you have what you need heading into sale opportunity.
So sounds like a lot of people hours here. How long does it take for someone to get secure about what their waterfront is with tax liability in the situation? So let's say that, you don't know what you don't know, but you've decided listening to this podcast that you're going to find out.
Mhm.
And you get that ball in motion, you select the right person or the right team. And then what? Is it going to take 2 weeks? Is it going to take 2 months?
Yep. Yep. It's that and then some. It's going to be fit. It's going to be customized to the actual circumstances, right? It doesn't make sense to bring in, a bazooka to act as a fly swatter. You know, you,
Right, because the maximum liability can roughly be calculated as 7%.
There you go.
comps. So you always do know what the ceiling is.
That's right.
And then you can make an effective determination about where you want your floor.
Yep, that's exactly it. And availability of information always helps. But I mean, I've turned around, I should say, pretty fast calculations, not quite doing the top line times 7%, but at least looking at some material states in an afternoon, looking at taxability, just to say, hey, I'm gonna go super conservative, super high level. This is probably where you want to think about spending more time. Then after that, it's a question of, okay, how much more time do we want to do? 80-20 rule, how much are we going to cover, et cetera. And then ultimately, what's this going to cost, right? So we want to make sure if there's liability of $25,000 in the state, we're not recommending doing a cleanup activity that's going to cost $15,000 to $20,000. The juice and the squeeze, right? It's not there. We're going to always recommend letter of the law, like I said, right? So to think about this is what the state requires. Here's how we can help, but we understand it's a business decision at the end of the day.
Awesome. So one of our founders is sure to want to talk to you more. So how can people in our audience get in touch with you, or what would you recommend if they want to look into this issue more deeply?
Sure. No, I'm happy to help. Again, my name is Rob Piechota. I'm on LinkedIn. That's Rob, R-O-B. Piechota is Piechota. And yeah, please reach out to me there. I'm happy to make the connection.
Thank you, Rob.
Absolutely.